Our project is on PetIQ versus Zoetis, a financial analysis and comparison. I'm Julian.
I'm Chris.
I'm Caroline.
I'm Catherine.
And I'm Grant.
The industry of animal healthcare is comprised of all products and services that boost animal health, livestock health, along with livestock productivity. It consists of medicines, vaccines, and medicinal feed additives for animals. In medicinal feed additives are things such as antibiotics and antioxidants that benefit pets' health. Additionally, the industry is continuously growing with a projected compound annual growth rate of 4% through 2024. Three main competitors that we're going to talk about in this presentation are PetIQ, Zoetis, and Mars. PetIQ is a newer company. It was founded in 2010 and offers prescription medication and over-the-counter treatments for animals as well as pet supplies and treats. Its foundation is built upon love for pets. It's strictly focusing on companion animals though, and not livestock animals like some of the other companies. The second company is Zoetis, and it is much larger than PetIQ, but that's because it has been around for 60 years. It's the world's largest producer of animal medications and vaccinations, and it manufactures medicines, vaccines, and diagnostic products for livestock animals and pets. Lastly, there's the company Mars, which is a versatile company known for candy and chocolate as well as pet food and veterinary care recently, ever since they've acquired the company called Whistle. And Whistle makes smart dog collars tracking a pet's location and fitness, so essentially it's like a Fitbit for dogs. So under that new acquisition, Mars has entered into the animal healthcare industry. We would say that the key drivers of this industry are pet owners' growing love and awareness of pet health. People continue to grow in love for their pets and animals. Between the years 2006 and 2016, U.S. pet owners spent over $28 billion more on their pets, which demonstrates the ever-growing industry is still increasing every year. Additionally, people are becoming more aware of pets' health due to pet dehumanization. There's been publicity around this, which has caused people to care more and just be more aware. One key challenge with this industry is consolidation. There is a concern that large companies will dominate the animal healthcare industry. For example, Zoetis, which I mentioned earlier, a well-established company, is now having many recent acquisitions. Further, there was a merger with Boehringer Ingelheim and Mariel, which are two animal health companies. And so because of these two large companies still prospering, there's question that if they will dominate the whole industry, but that's the main challenge with the animal healthcare industry. Further, because consolidation often causes an industry to cut costs directly.
PetIQ was founded in 2010 with the goal of creating low-price products for consumers. Throughout 7 years, they used penetration pricing to gain a lot of market share. And in 2017, they had an initial public offering of 5.6 million stocks at a price of $23 a stock, which comes out to a total of $132 million. After that, they expanded very quickly. In 2018, PetIQ acquired HBH Enterprises, who's an innovative developer and maker of pet treats with hopes of expanding their product line in the consumer market chain. To date, PetIQ has 10 active brand names, varying from dog and cat treats to medicines. VIP Pet Care is a new company who provides mobile pet care clinics across the United States, which hopefully will expand PetIQ's market to having clinics as well as products. Another large deal that PetIQ had this year was their initial deal with Walmart. Their goal is to initially have 20 clinics placed in Walmart stores around the United States, and by the year 2023, have over 1,000 clinics. Zoetis has a lot longer history than PetIQ. It was originally founded in 1952 as a division of Pfizer called Pfizer Animal Health. Since 1952, Pfizer acquired many companies, including a rapid growth between 2007 and 2011, where they acquired 10 large companies. In 2013, Pfizer announced they wanted to take Zoetis to market and make an independent company, not a division of Pfizer. They had an initial public offering of 86.1 million stocks, priced at $26 a stock, making it worth a total of $2.2 billion. However, Pfizer retained 414 million additional Class B shares, so they can keep an 83% controlling stake in Zoetis. Since the IPO, there have been 3 major acquisitions of product competitors worth a combined $3.2 billion. To date, Zoetis has 18 main product lines, with over 300 total smaller product brands that are produced and sold domestically as well as internationally. All those products deal with treats to medicines, and the medicines are both prescription and over-the-counter. Recently, in May of 2018, Zoetis acquired Abaxis for $2 billion. Abaxis was a veterinary diagnostics brand, so since Zoetis has acquired them, they're expanding their market into veterinary diagnostics, which is averaging a 10% annual growth per year over the past 3 years. This shows that Zoetis has the goal of achieving a lot larger market share across many pet needs.
Currently, the average Wall Street consensus on PetIQ is a buy rating paired with a $44 price target. As of now, it trades at $30 a share. From their recent earnings call, they reported revenues of $131.4 million, which is a year-over-year increase of 117%. As quoted in their most recent earnings call, the CFO said, "Third quarter results confirm that we're on track to deliver an accelerated net sales growth in 2018, and we are progressing well towards our long-term growth financial target of $1 billion in net sales and 15% adjusted EBITDA margin by 2023. For Zoetis, the average Wall Street recommendation right now is overweight with a price target of $97. As of now, the stock currently trades at $94.43. The net income between 2016 and 2017 for the whole year, as stated in previous 10K filings, has stayed relatively flat. And on their recent earnings call, they expect growth domestically to continue into 2019, but at a slower rate than this previous year of 2018. Internationally, Zoetis expects larger growth rates in the fiscal year of 2019. Net income currently reported at $347 million with an EPS of 0.71, growing at 16% for this past quarter. Grew operational revenue by 12% from previous Q3, and they said that they're currently reallocating resources towards future growth and trying to grow more for their shareholders and continue the progress that they have started. Also on the earnings call, the Zoetis management expressed that they were very happy with the acquisition of Abaxis and said that there's been great synergies and that everything has run smoothly so far. Now for the risks talked about on PetIQ's most recent 10Q filing. The first issue that was brought up was the fact that PetIQ gets most of its revenues from 2 main clients. These are Walmart and Sam's Club. They accounted for 30% from Walmart and 16% from Sam's Clubs of their net sales in 2017. Any changes in these orders or any financial burden to either of those companies would be a lot of trouble for PetIQ. However, they have said that they are trending towards a more diverse client base this coming year. The next issue is competition in the industry, and they are a relatively new company trying to break in, as well as they said on their 10Q that their failure to manage acquisitions, investments, or strategic alliances would have a very adverse effect on their company. For the main business drivers of PetIQ, the first thing I'll touch on is the deal with Walmart that we spoke on a little bit earlier. They're opening 20 veterinarian clinics in Walmart stores and plan an additional 1,000 veterinarian clinics in retail partner locations throughout 2023. This offers some positive insight to investors on the future growth of the company. Also, $27 billion was spent last year overall on veterinarian services and products, and this is projected to grow up to $34 billion by 2021 alone. So this shows you that the industry that they're in currently has a lot of room for growth, and if PetIQ handles themselves well and stays competitive, they'll be able to capitalize on a lot of that. Next, I'll go over the executive compensation structure for PetIQ's CEO and their CFO. These were listed for the CEO, which is Christensen McCord. He made $1,921,442 in total compensation. Of this, $294,000 was received as salary, $378,000 was received as a bonus, and $1.3 million was received in stock options. CFO John Newland received $2,488,238 in total compensation. Of this, $872,808 was in stock options and $1.6 million in cash. For the risks associated with Zoetis, the largest one that they mentioned on their recent 10Q was the fact that the U.S. is killing NAFTA and installing the new trade deal USMCA by 2020. They said that these new provisions, as well as any other changes to international trade agreements or policies, could harm our customers and negatively impact our financial condition as the result of operations. The main customer affected will be U.S.-based livestock corporations and producers. What will happen essentially is that if they are hurt financially, they will use less of Zoetis' products for their livestock. The next risk that they spoke on was trying to continue growing, as they already have a lot of market share, and foreseeable growth in the future, especially domestically, is unlikely. And lastly, there is the risk of a possible investor sell-off due to the fact that Zoetis trades well above its earnings on the market. The business drivers for Zoetis come from a few areas. The first one being that pet adoption and pet wellness continues to increase year over year. And the next is that the underlying need for healthy animals to produce safe and affordable food as livestock is still very essential in our economy. And Zoetis provides a lot of the materials and healthcare products for those animals to thrive. Lastly, I'll touch on Zoetis' executive compensation structure. CEO of Zoetis, Juan Ramon Alex, made $10,528,769 in total compensation. Of this, $1.19 million was received as salary, $1.75 million was received as a bonus, $2.43 million was received in stock options, and $4.86 million was awarded as stock, and $288,859 came from other types of compensation. CFO Glenn Davids made $2.79 million in total compensation. Of this, $1.29 was paid in cash, $1.4 was paid in stock options, and $101,000 was under the category Other.
Since the size difference of these two companies makes them hard to compare, the vertical analysis allows us to compare their balance sheets and income statements using percentages. For the vertical analysis of the balance sheet, we compare the components of the balance sheet to the total assets in 2017. And the key takeaways are that PetIQ's current assets make up most of the total assets, whereas Zoetis' distribution was more spread. PetIQ also had significantly higher total equity compared to total assets than Zoetis, and Zoetis had much higher long-term debt and total liabilities compared to total assets than PetIQ. For the vertical analysis of the income statement, we compare the components of the income statement to the total sales in 2017. The key takeaways are that for PetIQ, we are able to see that the cost of goods sold is 81% of the total assets, which accounts for the gross profit only being 19.19% of the total sales, and ultimately leads to the net income accounting for only 1.31% of total sales. On the other hand, Zoetis is much better than PetIQ at minimizing the cost of goods sold in order to maintain a 65.95% gross profit and operating income, and ultimately a 16.28% net income, which is much better than PetIQ. The horizontal analysis allows us to look at the growth and growth potential for each company by comparing the components of the balance sheet and income statement over the years. The key takeaways for the horizontal analysis of the balance sheet of 2017 compared to 2016 are that PetIQ had a much larger increase in total assets, cash, and equity from the previous year, and had a more significant decrease in long-term debt and total liabilities, all of which shows potential for continued growth. Zoetis had a significant decrease in total current liabilities, a decrease in accounts payable, and not as much growth, but no negative trends either. The key takeaways for the horizontal analysis of the income statement of 2017 compared to 2016. For PetIQ, there were significant increases in revenue, gross profit, expenses, operating income from the previous year, all of which had a bigger percent increase than Zoetis. And PetIQ also had a bigger decrease than Zoetis in operating income, net income from the previous year, which is due to high expenses, but this analysis still shows potential for growth. And Zoetis was fairly stagnant, with the only significant change being a large decrease in general and administrative expenses from the previous year.
If given the opportunity to invest in one of these companies, we would invest in PetIQ. Even though Zoetis is a much more established company, it's been around for 60 years, which is a much longer time than PetIQ, and it has a much higher market cap, there are actually more advantages of investing in PetIQ. For example, it has such an immense potential for growth, given that it's a much fresher company than Zoetis. And it's in the midst of launching all these new products. It's constantly looking for more acquisitions as opposed to Zoetis, which is kind of winding down in those areas. Additionally, PetIQ's growth, profit, and operating income is increasing, and the operating income increasing shows that they're still looking to make advances constantly. Reasons we wouldn't choose Zoetis is because trade is so far above earnings. Additionally, the company's price to earnings ratio is dropping every year. And in regards to operating expenses for this company, their operating expense and their net income have remained stagnant over the past few years, which shows that they're not looking for growth. If we invested in PetIQ today, we would stay in the company for several years, definitely for a while. This is because the company has just started up and it's hitting the ground running. And so for those reasons, we can't predict yet when we would withdraw from the company. Yet because we are noting the tremendous amount for growth, we would expect to remain invested in the company definitely for a while into the unforeseen future.
Delineating our position as a creditor, for PetIQ, we would choose to lend. This is because PetIQ displays strong potential for growth while also having a substantial amount of capital they can invest in the short term in order to make that growth possible. While the company is not currently making any profit, it is rich in both cash and other assets compared to its relatively low liabilities. PetIQ experienced a 33% increase in revenue from 2016 to 2017, demonstrating that they are growing their market share quickly. The company also paid off 35% of its long-term debt while taking on 39% more short-term debt. These figures together show that PetIQ plans on growing while remaining sustainable, since they are lessening their long-term obligations, but are also willing to increase their short-term obligations, since they intend to increase revenue even more in order to mitigate this. Some other key data points that led to this decision are PetIQ's current ratio of 5.99 and quick ratio of 2.08. This data shows that PetIQ has significantly more short-term assets than short-term liabilities, meaning that they can easily pay off debt quickly without significantly damaging day-to-day operations. PetIQ's debt-equity ratio is currently at about 0.53, which is an ideal ratio for any lender. Since they intend to grow quickly in the next few years, we will tolerate any leverage ratio less than 1 in the years 2019 and 2020, since they should be expected to take on more debt in order to finance their growth. However, from 2021 and onward, we would only tolerate a ratio of 0.7 or less. For Zoetis, we have chosen not to lend. Zoetis, while a much larger company than PetIQ, has mostly spent its growth. In the past 4 years, Zoetis has seen almost no change in its COGS and operating expenses, signaling that it either has no intent to continue growing or simply cannot grow any larger. It also experienced only an 8.5% increase in revenue from 2016 to 2017, also demonstrating that substantial growth is unlikely. Along with a small increase in sales, Zoetis increased its long-term liabilities by 13%, giving itself cash in the present but hurting its future profitability. Other key data that influenced this decision to not lend to Zoetis are the company's current ratio of 3.85 and its quick ratio of 1.43. Though it still has more quick assets than current liabilities, the quick ratio of 1.43 means that any debt Zoetis incurs could hurt its continued operations, since it does not have much idle cash or other current assets it can use for investments. Zoetis also has an AR turnover of 5.32, demonstrating that they are struggling to collect payments, a problem usually due to an issue in product quality. Along with its slow debt collection, Zoetis only sells its average level of inventory 1.24 times a year, which is very slow compared to PetIQ's inventory turnover of 4.89. Zoetis' debt-equity ratio is currently at 3.85, which means the company will have difficulty paying its creditors. Zoetis does not show any signs of reducing this high debt-equity ratio, meaning that it is a risky target for a loan.
Looking at 6 of PetIQ and Zoetis' key ratios can help us compare them. The first is profit margin, which Zoetis has the advantage in. Second, return on assets, Zoetis also has the advantage in. And the third, return on equity, Zoetis once again has the advantage. The next 3 ratios are price-earnings ratio, debt-equity ratio, and earnings per share. For price-earnings ratio, as you can see, PetIQ's ratio is non-existent due to having negative earnings per share on the previous slide. Zoetis once again takes the advantage in that. For debt-equity ratio, PetIQ has 0.54 and Zoetis has 3.77. PetIQ by far has the advantage in this, which is a big deal for PetIQ because they are a smaller company and growing at a very high rate. So having a low debt-equity ratio is super important for their growth and potential in the future. Final ratio is earnings per share. You can see Zoetis has $1.90 earnings per share, and PetIQ has a loss of 26 cents per share due to a negative net income. In the end, our advice is to invest in PetIQ due to higher growth potential, undervalued stock price, as well as its goals for expansion into larger consumer markets in the future. PetIQ is rich both in cash as well as other current assets relative to their low liabilities, allowing them to grow quickly and smoothly without many barriers stopping them. Although Zoetis is a much larger company than PetIQ with a much larger market share, their potential to grow is very limited compared to PetIQ's very large growth rate.